Okay, so welcome to the next webinar in the series. Our speaker today is Derek Sorensen. Derek is just about finishing up his PhD here. He turned in his thesis a couple of weeks ago, and he's going to be talking to us about tokenized carbon credits.
Great, thank you very much. I have two goals for this talk. The first is to give a talk that's worth listening to. And the second is to maybe, for those of you who haven't had the privilege of hearing my incoherent ramblings on maths in these meetings, maybe construct a story where you can see how on earth my work has anything related to this work, to this group, sorry. So I'm going to be talking about tokenized carbon credits, which are carbon credits that live on the blockchain and are digital assets that are traded and retired on chain. Before starting, I want to point out these two pictures. I used AI to try to get some nice pictures for sustainability plus crypto, and I just got these awful pictures back. This one was, I was trying to get a Bitcoin wrapped in leaves, but in like a nice, something that had nice design. And of course, this is just gross. And then this one has dead leaves, and maybe the AI was opining on crypto and its value to sustainability. Those leaves should be living. And in the prompt, I asked for green leaves, so our jobs are safe from AI, at least for now. Okay, so let me figure out how to. All right. Hopefully that will go away soon. There it goes. Okay, so just a quick outline, what we're going to talk about today. It's fairly simple. I'm going to give an introduction to blockchains and smart contracts. I will actually look at some code just so you have a very concrete idea of what's going on the blockchain. And then we're going to talk about carbon credits and then tokenized carbon credits, thinking about why the blockchain, looking at some examples, and then we'll focus on sort of the vision, the risks, and the future work. And in particular, it's in this where kind of the story to my research is completed. So let's look at blockchains first. Blockchains, out of the box, a blockchain will come with three fundamental primitives that are important to understand to kind of figure out what's going on chain. The first is that every blockchain has a native token. So for Bitcoin, that's BTC. For Ethereum, that's ETH. For Tezos, that's Tez. For Solana, that's Sol, et cetera, et cetera. There's always a native token. And fundamentally, blockchain is a ledger where there are addresses that hold balances in this native token. Addresses come in two forms. The first is in the form of a wallet. And this is an address that is assigned to some sort of off-chain external entity, typically a person, or like a machine. It's just a key value pair, sorry, not a key value pair, a public-private key pair. And if I own a wallet, I can have a balance of this native token in my wallet, primarily. There are also addresses that are signed to smart contracts. And smart contracts, rather than having an external entity controlling the wallet, a smart contract is an address and also an attached program that sort of controls the address, and it also has a balance. And so the programs that govern addresses, these smart contracts, that's kind of what we'll be thinking about. Typically on blockchains, the form of these addresses they'll be different between wallets and smart contracts. So Tezos, for example, starts with a TZ for wallets, and then 1, 2, 3, 1 or 2 or 3, and then a hash. And then smart contract addresses typically look like capital KT, 1 or 2 or 3, and then a hash. And that's just sort of how most blockchains operate in this way. The third primitive that you need to kind of think about when thinking about blockchains are transactions, and that's how things happen on the blockchain. So there are three transactions types. One is that addresses, either wallets or smart contracts, can transfer their balance of a native token. So that's one way to transact on the blockchain. If I have an address, I can transfer tokens. Another one is I can deploy a smart contract, which is that I have code that will govern an address, and I deploy it to the blockchain I give it some money, some of the native token, and then off it goes. And the third is that I can call a smart contract. I can interact with a smart contract. Typically, anything that's happening on chain has to be initiated from some entity off chain. So like a wallet, for example, a wallet will initiate the deployment of a smart contract, and then a wallet will also call a smart contract, although contracts can call each other too. Those are three things: native token, addresses, and transactions. Right, so let's think a little bit more about smart contracts. These are kind of, from my point of view, the most interesting thing to think about when thinking about smart blockchains. What we're going to do here is we're first going to take a look at a generic smart contract, and then we're going to look at some important examples that are relevant to carbon credits in particular. So a smart contract also has three things. It's just all about threes right now. Also has three things that are associated with it. It has a balance, like any wallet does, of the native token. It has storage, which is some data that's associated with that address. And then it has entry points, which are ways that you can interact with a smart contract. And so what you do is you call an entry point, and then the smart contract will act on its storage, maybe updating some values. It might send some of its money around, and then it returns an updated storage and kind of some more transactions. So we'll see this right away. Right, so here's some example code of a very simple generic smart contract. This was taken, this was taken from the Lego Lang website, which is a smart contracting language for the Tezos blockchain. And if we look at the code here, we have a storage type, which is just an integer. This type ret, the return, is always the same. It's always a list of operations or transactions. So, or storage, and that's sort of that's the type that indicates what happens after the smart contract is called. And then it has three entry points. The first is increment, second is decrement, and the third is reset. The increment function takes an int, and it takes its storage, and it returns. It doesn't do anything, so it doesn't emit any more transactions, but it adds the delta that you gave it to the store. So it increments by the payload you gave it is this delta, and it increments its own storage. A decrement is the opposite, where you give it a delta and it subtracts it from the store, and then reset puts it back at zero. Yeah.
Questions through it, or do you want to take them at the end?
Please, yeah, anytime.
Any relation to Golang, or is this just?
No, it's actually it's been a little while since I've coded in Lego, but it's meant to imitate OCaml actually, or it's meant to have an ML. Now that I think about it, there are actually variants. There's a JS Lego, which is JavaScript, and then there's Camel Lego, which is kind of like OCaml. Anyway, nothing to do with Golang. Yeah. Okay. But yes, please, questions anytime. Okay, let's look at a slightly more interesting smart contract.
It might help this last part. The thing you can't do with this that you can do with Golang is that you can't infinitely reverse. So these eventually have to terminate at some point because they have a limited amount of resource on the blockchain. So this basically stops you from running code that will just run forever.
Yes, thank you very much. That's actually a very important point that I skimmed over, is that on the blockchain, everything is highly resource constrained. And so every transaction has costs associated to it, which is paid for in the native token. And that native token is also the incentive mechanism that you use to incentivize miners to do any mining, or validators to do any validating. So the kind of underpinning security of a blockchain is highly it's built on incentive mechanisms that are all predicated on some digital asset, the native token, that at least in principle has value. Right. So let's look at this. This is the code. Some of you may recognize this from the kind of pipeline stuff. This is the code for a token contract. Let's see if we can. we're going to briefly kind of just take a look, and we're just going to see the highlights of what I've just talked about. Is that, recall, every smart contract has storage. It has.
I think the font size might be.
Yeah, it's kind of hard to read.
Okay, is that more legible? Can I get rid of this side?
Yeah, I think
there we go.
You kept it in the dark.
Oh, that's the opposite.
Nope.
Oh, there we go. Okay, so right, this is a smart contract. One of the main kind of smart contracts that that people do is a token contract. This is a smart contract that keeps a ledger and is meant to represent a token of some kind. So we have, importantly here, we see our storage type. So this is the type of storage, and we have a bunch of things that are important for the functioning. But the main thing is that we have a ledger, which is a map, as the key is the owner, and the value is that owner's balance. Typically, virtually always, that's a natural number. The result type is the same thing it always is. If I call the smart contract, it will emit more transactions and give me an updated storage. I have a bunch of data about the specific entry points that we won't look at, but this is the entry point. This is how I can interact with my token smart contract. I can, if I have a balance, okay, sorry, I should not be highlighting things. If I have a balance, I can transfer my balance, I can query my balance. This minting and retiring is sort of, how are these tokens, how are they minted, how are they kind of printed, created, and then retiring in this particular case, these are for carbon credits. And so there's an entry point to that smart contract that governs this token that allows you to take the token out of circulation, which we typically call burning, but in the case of carbon credits, kind of don't want to confuse those words. It just doesn't sound quite right. And then if we look all the way down here, here's the code that's kind of governing the whole everything. All the way down here, we have the kind of main function, which represents my smart contract, which it takes in a payload of the entry point type, takes in some storage, and then it gives a result in the end. And so again, we can transfer, query balance, mint, retire, and then there are kind of other admin things. This is a token contract. These are virtually ubiquitous, and one of the kind of main smart contract primitives. Right. Yes.
So if I'm understanding correctly, we have the native token, which you write a smart contract with, and
yes,
use that as a sort of underlying currency.
Yes.
And then you have a derivative token, which could represent something like carbon credits.
Yeah. I'm not quite sure what you mean by derivative token.
Like, we have the native token, which is what the blockchain uses. You write a smart contract, which creates some sort of virtual token that only has a notion within that smart contract.
Yeah. That's exactly right. And so, token contracts come in many different forms. Could be carbon credits, for example. Could be a stable coin, which is a token that's meant to trade at the same value as $1 per one token. Or many other things. Could be NFTs, the non-fungible types tokens, which are kind of made popular by art. So yeah, tokens come in a very large kind of variety. But yeah, right. Another very important type of smart contract are decentralized exchanges. So we have smart contracts that give us tokens, and these tokens are, at least in principle, digital assets of some kind, or often they're trying to represent digital assets. Then we have smart contracts that are kind of built on top of those, which facilitate trade between these tokens. In particular, we can have markets on chain. So the way these work is I'll have a smart contract. That smart contract will be able to own tokens of different kinds, and it has typically at least 3 entry points. The first way I can interact is if I want to make a market. That means if I want to deposit tokens that can be used for trades between a token pair, I can deposit liquidity into this smart contract in exchange for some transaction fees. I can withdraw my liquidity, and then I can also, if I want to make a trade, I can make a trade. And so there's a huge variety of different kind of decentralized exchanges. These are smart contracts to trade tokens. This graphic is of what's called an automated market maker. And the short story of that is that there's a smart contract. It owns a bunch of assets that people have deposited. And so it's able to make a market. And how it does it is if I want to make a trade in this smart contract, it's encoded into the trade entry point. It will calculate prices based on its kind of relative liquidity. And what I mean by that, if I am trying to trade token A and token B in this smart contract, and I have a lot of token B relative to my amount of token A, that means token B is cheap relative to A. And so it prices kind of uses a curve. And anyway, the point of this is that we want to trade on the blockchain, and there are lots of options to trade. And I'll make a point, just like in tokens, we have a distinction between fungible and non-fungible tokens. A fungible token is one that's very substitutable, like a commodity or like a currency, like 1 GBP here is the same as 1 GBP there, for all intents and purposes. And non-fungible, it doesn't have any substitution, so it's like unique. So it's much easier to trade with these decentralized exchanges with fungible tokens.
So question.
Yes.
Who owns the exchanges and who runs and maintains regulation and all those things?
Well, yeah. That is a wonderful question. I'll speak from the perspective of kind of a crypto person. The idea is that no one owns the exchange. It's public infrastructure. What that means is that someone has deployed a smart contract, and now it just lives on the blockchain, and it can be interacted with by whoever wants to interact with it. And most exchanges, there is some kind of admin who will do upgrades and gets transaction fees and things like that. So there will be an entity actually attached to it. But it is possible to make these exchanges that are just totally neutral, with no owner, and yet they function. That of course has all sorts of legal and regulatory ramifications. One of those is if there's a problem with it, who to sue, which is a great question.
There's a lot like currency exchanges, exchanging dollars for pounds. It's exactly the same.
Right. Oh, interesting. I never thought of it that way. That's interesting. Right. Okay. So now we have blockchain stuff, and let's kind of put that to the side for just a little bit and just think about what carbon credits are. I think there are members of the audience who will be much more intimately familiar with the details of actual real world on the market carbon credits than me. So I'm going to do my very best to give a description. Please correct me liberally if I get some of these details wrong. So a carbon credit in the world, we're thinking of off the blockchain, just kind of traded in the market now. This is kind of the story of carbon credits, is that there's a project somewhere that's sequestering carbon, for example, or preventing deforestation, or even some carbon credits are attached to technological innovations that are kind of lower in emissions. And there's this kind of agreed upon legal framework where those who are sequestering carbon you get a trusted third party in who surveys everything, quantifies how much carbon you've captured, gives you a certificate that says you've captured this many tons. And then for those who are emitting, who would like to offset their emissions, they can buy from you. And so you have the kind of this cash flow into the sustainability projects that atones for the sins of the emitters. Vera and Gold Standard are two kind of groups that will come in and take a look at your project. This is typically a pretty time and labor intensive process to actually evaluate how much carbon and lots of non-trivial scientific questions, which many people in this research group and over at the DAB are working on very hard. Right. So we might ask ourselves, why is this relevant to the blockchain? And I'm going to try to make the argument that there are good reasons why we might want to have carbon credits on the blockchain, to trade them and to retire them on chain. And so I'll take for granted that carbon credits are a tool that we actually do want to use for climate change mitigation. Now, those more involved with carbon credits probably have a much more nuanced view on the efficacy of carbon credits, but I will not touch that at all. We're assuming carbon credits are good. We want them. We want to trade them in high volumes. And so now why might we want to do it on the blockchain? There is actually a pretty substantial literature making an argument for why we might want to put it on the blockchain, both from academics and also from kind of institutions that are important, like the UN or the WEF and the World Bank, all kind of put forward this as the blockchain may be the place that we want to kind of trade carbon credits. So there are a few key advantages. The first is that the blockchain provides for a natively global marketplace, because the blockchain is accessed through the internet, and all you need is a wallet, which is very, very easy to make. It can be accessed by anyone with an internet connection at any time all around the world. And because climate change is a global coordination problem, it makes sense that the markets, if we're going to solve this with a market, we would want that to be kind of on global infrastructure. This is probably the most important of the advantages, is that the blockchain is radically transparent, and it's a ledger that is permanent. And so it's really good if you have assets people are trading and you know who is who owns what wallets. You can see exactly what people do, how they trade, when they retire, and it's there forever. So contrary to despite the fact there are many kind of bad actors in blockchain and lots of scams that we have seen, the blockchain it can be hard to do. This is probably too strong a statement to make. I'm going to say it anyway. It can be hard to do crime really well on the blockchain, precisely because you have your footprints that are just there forever. And we are in actuality prosecuting money launderers, et cetera, from several years back, because you have just the evidence in front of you, at least in principle, right? Okay, blockchains cater to the underbanked. Especially in the case of carbon credits, where most of the emissions that we care about are coming from the global north, and most of the projects that are capturing carbon are in the global south, which tends to be less well banked than the global north. At least in principle, what we want is to have money essentially from the global north flowing into the global south to kind of do this, to fund these projects. The blockchain is a really nice way to get money to people who are underbanked, because you don't need all these kind of legal and societal infrastructure in order to receive money through a blockchain. All you need is a wallet. Of course, you do run into the problem of how do you spend that money, so it's not a perfect solution, but it's kind of on its way. The UN makes the argument that mobilizing green finance, the blockchain is a good place for that. There's the kind of industry jargon MRV, monitoring, reporting, verification, which people seem to think blockchain is a good place for. Finally, carbon credits are straightforward to digitize. They're not physical like commodities in the way that gold is, but rather they're already kind of in certificates in databases, and so they're already kind of a digital asset that makes it much easier to put them on the blockchain than something more physical. And then finally, and we'll talk about this a little bit more, is that smart contracts are robust in their ability to be composed with each other. So you can make quite sophisticated financial infrastructure very quickly on a blockchain, which may be desirable for carbon credits. And we'll explore that particular point in a minute. There are some key disadvantages. The first is that all of this is really quite immature as technology goes. There are severe risks associated with financial activity on the blockchain. In particular, this is DeFi, decentralized finance. It's sort of an umbrella term for financial smart contracts on the blockchain. And they're exciting, they're kind of weird, they're innovative, and they're fun, but they're also extremely risky. And then also we have many problems with compliance jurisdictions, legal things like the one you pointed out, but then and then just many others that we're sorting through legally. So the technology, it will take some years to actually mature, so it's usable in a real sense, and that's kind of what we'll look at. So even despite all of these risks, there are actually several groups, companies that are actively putting carbon credits onto the blockchain, and there is an ecosystem around it. And that's kind of what I want to explore with you guys today. So the first is Toucan. Their logo was in the last slide, that little toucan. And they have a process, and we'll kind of go through their process of putting carbon credits on the blockchain and just kind of think about what it means for us. So first, we have projects, and these projects have carbon credits that they've gotten from Vera, for example. And they're on kind of legacy ledgers somewhere on some server somewhere. And there's some kind of online portal you can use to access this. You can retire the carbon credit, or you can transfer the carbon credit on these legacy ledgers. So to get the carbon credit onto the blockchain, there is this Toucan carbon bridge is what this is. It's a somewhat convoluted process that involves first you initiate the process, you create a smart contract, and then you transfer your carbon credit from a legacy ledger to Toucan, and they give you like a confirmation number. Then you input that into your smart contract through an entry point. And anyway, the process of actually getting an asset on chain is quite complicated. It's hard to do in such a way that you don't get double spending and other kind of attacks. And so anyway, this is kind of a whole topic in itself. Once you've successfully bridged your carbon credit, what ends up happening is effectively
You mean it's hard to get any asset on chain or just for carbon credits?
Any asset. The problem of tokenization is it's hard. Yeah. So once you've bridged,
And does Vera emits like some kind of certificate that you know they are not like double counting? Because like if you're inputting, you want to be sure that like are just inputting whatever emitted by like the voice, proving that it exists.
Right. Yeah. So what happens is you end up retiring the carbon credit. With Toucan in particular, you end up retiring the carbon credit on the legacy ledger. And when you retire it, you include data about your smart contract so that you can connect the token to that particular carbon credit that was retired.
No, but like how do I know that like this carbon credit that was emitted by Vera is the traceability is emitted and like inputting on the chain?
Right. So the smart contract will have metadata that points you to the legacy ledger, the particular carbon credit. And then if you go to the legacy ledger, by the time you've bridged it, it will be retired. So you can't trade it or do anything with it anymore. And the retirement will have data about that points back to the smart contract after this process. Yeah.
So is Toucan retiring these at the point they're bridging them, or they retire them later on?
Yes, Toucan is retiring them when they bridge them. There are others that don't, and they hold your carbon credits custodially, and they allow you. It's a two-way bridge. Toucan is a one-way bridge. Yeah. So crucially, what happens is out of this process, we get a token that's in a token contract, and this won't be fungible. And the reason it's not fungible is that the token contract will contain all the metadata that points back to the individual carbon credit that was on the legacy ledger. And so you can't have just this immediately, you can't have a fungible token because that would have to erase all the metadata. You'd have to be clumping a lot of carbon credits and say that they're substitutable one for one. But you need to keep the metadata associated with the carbon credit. So you get a non-fungible token. That's fine and all, but those who are the groups that are porting carbon credits on the blockchain want to trade them with these decentralized exchanges, and it's hard to trade non-fungible tokens. And so you need some way of pooling carbon credits together, and there's kind of this fungibility layer where you say, oh, any carbon credit from vintage, so from maybe 2005 to present that deals with rainforest conservation can be emitted into this pool, and you put your NFT into the pool, and in exchange you get a fungible token that just represents something, a carbon credit for the pool. Yeah.
What is the granularity of these tokens? So are they these NFTs? Are they like in 1 ton units, or are they the total tonnage of the project?
Typically, it's 1 ton per NFT. Yeah. In fact, I think every project that's live, it's always 1 ton per token.
So if this succeeds, then it's totally unsustainable, right? Because every NFT is always on chain permanently. And so if you retire credits, then the complexity is ON with respect to the number of total issued credits overall time. When you retire a credit, the NFT will be permanently marked and tracked as retired. And then you have to keep using that forever, right? You have to track those forever. So you cumulatively create more and more carbon credits, and the total storage of the chain just increases over time.
Yeah, I mean, every time the carbon credit gets bridged, you have a new smart contract. So that will, you'll just be making new contracts. And as you retire them, I think that is the same problem as you have with just sustainability of the blockchain itself, because there are lots of reasons to be creating lots of contracts all the time.
That's something we intentionally try to avoid with our contracts on Teslas. That we only have one Tesla's contract, and we don't store the actual tokens on chain.
That's true.
So they only need to stay in the archival nodes and not on the live nodes.
Yeah, I don't know enough about how blockchains kind of keep and optimize their storage, because the chain getting too big to handle is a problem. And so one way to solve that is that you truncate the history. And so you don't have to, not every miner or validator has to keep the entire history on their machine. And there's this kind of whole protocol around that. My impression is that making a new contract for every token is not actually a problem for the kind of computational intensity. What is more of a problem is that block space is limited, and which means that there are only so many transactions that can happen per block or per second. And so if there is a great deal of traffic, on the blockchain, it can become quite expensive to use the blockchain, because when there's too much traffic, what you end up doing is you end up kind of auctioning off block space, and block space becomes more expensive, and any transaction goes into a block. Yeah.
Are layer 2 chains a potential solution to this? That's something I've heard.
Yeah, that would just be the general scalability problem. And there are a few ways to address this. There are some blockchains that optimize the layer 1, just the blockchain itself and consensus, so that it can handle more without, well, at least hopefully without sacrificing decentralization. Another option is these layer 2s, which are rollups. And one way to think about a rollup is it's a smart contract that emulates a blockchain. And so you can do a lot of computation off chain and then settle on chain. And that is Ethereum, for example. That's their kind of roadmap scalability. You can also kind of shard the blockchain, and so you have the state kind of separated, and what you end up getting there is kind of a hierarchy of chains that all talk to each other. Yeah.
And is Toucan on L2, or is that on
Toucan is on Polygon, which is what's called a parachain to Ethereum, very similar, but it would be the equivalent of L1 on Polygon. It's also on a separate blockchain called Celo, which is a blockchain that's entirely devoted to sustainability. And I don't think Celo has layer 2s. Celo, I think, is just the regular layer 1. There's not enough traffic to warrant layer 2s yet. Right. So Toucan is one of many. There are other groups like Flow Carbon, Moss, Carbovalent. What they all have in common is that they have some methodology that they accept that kind of substantiates the credits. So this will be Vera for Toucan. Flow Carbon uses gold standard. Most is just Vera gold standard. There are some that use their custom methodology, but that kind of comes with baggage of making sure it's reliable, of course. And what always happens is you have a token, it's not very fungible, and so you have a fungibility layer that you kind of put on top of it. The only exception to this is Moss here, which when you give them a carbon credit, they just kind of forget all of the specific details of that carbon credit and they just give you a token. So it's the most accessible from a retail point of view, but the least interesting, I think, from a long-term point of view. Right, and there is kind of a trajectory and vision that people in the industry are trying to go for. There are some projects that are trying to collect climate data in this decentralized kind of blockchainy way. A good example is a group called DClimate, and they have a blockchain oracle that the basic process, or at least in principle should happen, is that anyone can collect climate data, whether that's a thermometer or whether that's like wind speeds on top of their apartment or something like that. And they can post the data to the chain, and any application that uses that data has to pay to fetch the data. So you have a blockchain for the data of climate data, and then, you know, in the best possible world from this kind of crypto point of view, you have the blockchain that has all the carbon credits, and what you do is you have this transparent methodology that pays for the data, grabs it, mints carbon credits in this very kind of transparent way, so we can see exactly where every carbon credit comes from, what's substantiating it, and it kind of points to everything, and then everyone who was involved in the process gets paid. So data collectors, that's kind of the vision, and in keeping with the ethos of blockchains, everything is meant to be all decentralized and permissionless, and whether that's possible or not, we will see. Right. So aside from just the tokens that represent carbon credits that are actively on the blockchain, there's also an ecosystem of kind of applications that are built on top of these tokens. And this is where the composability comes in. This is a picture illustrating the jargon in the industry of calling smart contracts money Legos, where you can just sort of take them and put them together in a very straightforward way, building things like you would Legos. And so there are offsetting services where we can see all the carbon credits that are on these various chains, and maybe you have some event and there's an oracle that pings the event every time, like maybe every month you're offsetting your emissions or something like that. And there are these services that can do that automatically for you. There are this new experimental kind of range of things are carbon-backed assets. And so you have a token that is in principle meant to be used as a currency, maybe a stable coin, and what backs the token is carbon credits on the blockchain. These are very experimental. One of them, the biggest one that I've seen, kind of looks like a Ponzi scheme. It's every smart contract has this kind of economic layer on top of it of incentives and incentive systems that's hard to reason about and hard to get right. And
is that climate?
Climate down, yeah. And then there's climate insurance, which in particular draws on climate data, like on DClimate. And then there's a more kind of fun version, which is art and gaming. One way that I might be able to contribute to the carbon markets, if I'm an artist, is I can make digital art and then put it on the blockchain as NFTs, and then I could encode into my smart contract royalties of any of my sales, and any secondary trades of my NFTs go to a certain project that's capturing carbon. And then there are actual games that kind of interact with the ecosystem in a very kind of crypto way. Right. So as I wrap up, I just want to talk about some challenges that we face if we actually want carbon markets to be on the blockchain. The first is that smart contracts are very dangerous. They're hard to get right, and they're catastrophic if you get them wrong. Related to that is that every smart contract has with it kind of an economic and incentive layer. That's, again, hard to get right. I'll give some more details on each of these. And then, of course, the looming sanctions, jurisdictions, all of these things, these legal compliance issues. So the first, smart contracts are dangerous. Smart contracts have the key property that once you've deployed them to the blockchain, they are totally immutable. And so if there's a bug in your code or flaw in your design and there's some attack vector that you didn't foresee, there's nothing to do but watch your smart contract be exploited. There's just no way around it. And so that's very scary for projects that manage lots of assets. There are lots and lots and lots of high profile, very expensive attacks on smart contracts because of the immutability. The second is that smart contracts live in this kind of economic world that does not behave quite like the real kind of normal world. I'm going to give a quick example of what's called a flash loan. There are smart contracts on the blockchain that you can lend. I can put money into this contract that gets lent out to someone, like what happens in a bank, except for there's no intermediary to take the money, so I get all the interest on my funds. So it's kind of this cool, and these protocols are very big. One of the biggest ones is called Aave, and they regularly have more than $1 billion worth of assets that are lent out at interest. So this is cool. One service that they offer, there's this kind of interesting property of blockchain that if a transaction either succeeds or it doesn't do anything. So if there's a transaction that's getting executed and it fails for some reason, the entire transaction gets rolled back. So what I can do if I have a lot of money that I want to lend out, I can lend money on the stipulation that in the same transaction that I lend you the money, you have to repay your money to me, which makes no sense in the real world, but it makes a lot of sense in the crypto world because I can do a lot of things in one transaction. In particular, if Aave is giving me this flash loan, I can borrow like a whole ton of money from Aave. I can go and manipulate a market, make profit from that manipulation, pay back my loan all in one and keep the profits. And this has caused some unintuitive and very strange attacks that were really hard to see until you can see how weird flash loans are. So in particular, these kinds of weird economic behaviors are a real source of vulnerability if there is real, genuine carbon market infrastructure on the blockchain. Yeah.
This is only because of the resolution that's like limited by the transaction, by each kind of transaction, because you're saying this is only happening. This seems like normal investment thing, right? You lend money, you do properly, you repay.
Yeah.
But you're saying this is happening because suddenly there is a granularity to how often things happen, and if you do it all within one loop, you can. Yeah,
I think that's a pretty good way of saying it. Things happen one at a time, I guess, in sequential order, and this is all one transaction. So it either happens completely and Aave lends and gets their loan paid back with interest, or it never lent at all. Another way, in this kind of granular sequence of events, this is sort of one instantaneous kind of event all at once, which is not like a normal, like if I'm in a normal market, I might be able to do this, but then Aave would shoulder some risk. So maybe my market manipulations went wrong and I couldn't repay them. Aave would actually have to shoulder some risk. But in this case, there's no risk for the lender.
It might be worth mentioning that one of the real dangers here is that if you make a flash loan and you end up owning more than half of the tokens there, even just for one transaction, then there's governance issues at stake as well. So often these chains in the contracts allow you to vote for changes in how they operate based on a majority consensus of ownership. So in that case, if you can just temporarily own more than 50%, you just rewrite the laws of the land and then you own everything. So that's one of the dangers of having everything codified as contracts that are digitized, is you have to make sure that absolutely everything is protected against rewriting the code by transacting.
Yeah, most smart contracts, including the blockchain itself, the blockchain security is underpinned by people owning the native token and getting rewarded by it, and in order to keep consensus on the state. And so, and many smart contracts are governed by people who own tokens, which and the logic there is that there's some sort of incentive, game theoretic incentive structure that you make an argument, oh, if someone owns a large stake in this project, they don't want to see it go down, and so they won't kind of trade with these people that are malicious, and the incentives, at least in principle, line up. The problem comes in when you can move huge quantities of money instantaneously at no risk. Then you can do stuff like that. Yeah. Yeah.
This is really worrying. Is there any hope you'll ever fix this situation?
Well, I'm so glad you asked. I spent 4 years thinking about this. So this is the connection to my research. Is that smart contracts are hard to specify in a way that is secure against these kind of weird manipulative attacks. And so the connection from all this to my research is that if I have a smart contract, suppose I am so sold on this carbon credit blockchain narrative that I'm just going to build market infrastructure that's going to facilitate this whole market and our coordination problem, and that's what we're going to use. I have real risks that I have to face. Not only do I have to ensure that my smart contract has no bugs, so that the contract matches my description, my specification, but I also have to make sure that my design isn't manipulable by these weird things that happen on the blockchain. And that is hard to do. And so I wrote a PhD about it. Yeah. Right. And then the last, I'll wrap up here in the last minute here, is the last thing that we have to worry about with smart contracts in these markets is that not only is it, because it's a global thing, you have people from different countries interacting financially, you may have problems with jurisdictions, et cetera, and compliance. It can be hard to do know your customer checks that are standard for banking, these KYC, these kinds of things. But you also, it can be very hard if you have an open kind of smart contract to make sure that North Korea isn't using my contract to make money, or some like terrorist organization isn't getting funded. And so there will be individuals who are sanctioned with whom it's illegal to interact. And it can be hard to know if that's my counterparty is trustworthy or regulated. There are bad actors that manipulate. And then the last thing I'll say is that we had a problem in the last year or so with a smart contract called Tornado Cash. That is, I mean, one way to describe it is it's a mixer. It's this private pool where if I have funds, I don't want people to see what I do with my funds, I put them into the pool. And that way I have privacy on chain. And that's cool. It's kind of cryptographically secure. But it also means that if I'm laundering money, that's a great place to put my laundered money. And so in particular, there's this group, one of the developers was in the Netherlands that made this app, this Tornado Cash. And then it was discovered that some North Koreans, government officials were using it to launder money, et cetera. And that not only did it become illegal to host a website that interacted with this smart contract, but the author of it went to prison in the Netherlands. So that kind of sparks a whole bunch of things, but what it's related to in the case of carbon credits is that there, I mean, there are ways to manage this, like knowing who's interacting. You have to keep in a ledger somewhere people who are approved and people who aren't. That's tedious and it could be expensive, and you could have a problem with the memory exploding, and then that becomes very expensive. So that's just something to consider. Yeah, that's it. So the conclusion here is that blockchains seem to be a natural place to put carbon credits. And there is an ecosystem. This is happening and things are developing. People are really passionate and committed, hopefully innovative in a way that's productive. But there are questions, and they're hard questions to be asked and answered. And that's my talk. Thank you very much for listening. Are there any questions or, yeah? Yeah.
It might be obvious or not. But anyway, I'm going to ask anyway. So carbon credits, all of these initiatives, just taking a step back,
yeah,
is to make change. You know, hopefully climate change is going to go away eventually.
Yes.
So that's all the physical side of that.
Yeah.
We actually want to have change. Now, with all of these, now we're doing trade on blockchain, making it easier to exchange. Is there a risk of then people playing the money game or the number game, push up prices, and then become at the end is all about, you know, it's just a number game?
I mean, there's nothing in the blockchain infrastructure inherently that would take that risk away. And so insofar as that's a risk for carbon credits, to me it seems like that is definitely a risk on chain as well. Yeah. And I haven't really thought about any ways to mitigate that. I don't know almost anything about economics and what is desirable, what's not. But I also don't see any inherent barriers to kind of trying to foresee bad actors in the economy and trying to. The cool thing about smart contracts is they're so programmable, and so you can be pretty precise in how you want assets to flow, and so at least in principle,
yeah, and sometimes it's not even down to the bad actors as such, but
there's natural
natural
market incentives. Yeah,
market as soon as you do, and then people start to sort of want to just trade, but then it starts to become more detached from the actual what we are doing with carbon credits in the first place.
Yeah. And the hard thing about smart contracts is that because they're immutable, it's not a good place to sort of experiment, move fast and break things, see what works, see what doesn't, and adapt later. Like you can upgrade smart contracts, but you have to encode beforehand the process to doing that. And you may have governance associated, and like Anil said, that might be able to be hacked, and then it could blow up in your face. So you have to do a lot of thinking beforehand if you want to do anything serious with a smart contract, which is one of its downsides. Yeah.
There is a question from Amelia online. Amelia, could you please unmute yourself?
Yeah, I guess just building on the question that was just asked, I guess another way of thinking about it is we've said sort of like as a premise, we're going to assume that we're going to assume that sort of like payments for ecosystem services or things like that are a good way to deal with the climate crisis. But I think maybe the question that's unaddressed is, why are carbon credit markets the right idea? So why is it important, or what are the major risks in having all of these things about trading, investor speculation? Why is that important?
Okay, I think in my talk, I think I kind of took for granted that we want credits and markets. From what I'm told, markets are important to be able to price things and price carbon. I don't think I can authoritatively say anything really, honestly, toward that. I think that's a whole separate question and a real question that we should ask, whether we even want markets at all.
Hang on, but you had that in your talk. You said one of the goals of this is to catalyze nature finance, to bring more money into it that would otherwise be there before.
Yeah, that's fair. Okay, that's a claim made by there are a lot of people who make this claim. I'm able to restate their claim, although I don't know the economic substance of the argument. I honestly, the reason for that is that it seems to me a very complex question. I'm optimistic about markets, but I'm really not the person to ask about markets.
There's an opportunity here, which is if you can make it transparent all the way through to the initial issuance, right the way through to retirement, then that transparency will mean that there are better price signals, and also that maybe there's fewer excessive profits being made by brokers in the middle. Right?
Yeah, I think one would hope. Yeah.
So I understand the kind of underlying tokens because but I'm not quite sure what does the smart contracts introduce that change the rules, because I'm aware that on these blockchains it's immutable. So if someone tricks you into sending money, there is zero hope that you're getting it back, because it's just you would have to rewrite the whole history. That's why smart contracts are immutable as well. What does it mean for the carbon credits? Because they exist not as a token, but then as a thing on the smart contract, right? Does this allow for erasure of, because you find out that this carbon credit was vain or useless, does it allow for any modification later that propagates through a system? Well, you can always find that if you zero it, you can trace the line of this credit through here, but you can't really change stuff, right? It's not, if suddenly a certain token that entered proves to be zero carbon, like zero carbon removed, that doesn't actually mean anything for the system, right? You can't change the original value of the carbon. You can't force these companies would buy them to reevaluate how much carbon they've offset.
You can change it if in the smart contract that governs the carbon credits in these tokens has a provision to do so. And then you have to decide who has rights to make changes and make sure that's a safe thing to. You can also, another way is if there are robust markets and it's discovered that one particular carbon credit was actually trash, then the price will drop and go to
are
zero.
Smart contracts as flexible as any other piece of code? And it's the kind of meta aspect that you always see them transparently that is different, or so can you write any piece of code, including where you have functions that can modify the amount of carbon stored?
Yeah,
all these things?
most smart contracting languages are Turing complete, so you can really do anything you want with them. You are in a resource constrained environment, so you have to pay for every transaction, and so if it's too computationally complex, you may just not be able to afford it. But the smart contract governing a carbon credit could be robust enough to respond to these things or kind of reevaluate what was this credit actually worth looking back maybe 5 years and kind of redoing things. But importantly, that functionality has to be encoded when you deploy in the original deployed smart contract.
Okay, yeah, I think we should wrap up this. Yeah, thank you very much, Jared.
Here's my bonus slide. This is a court sketch from last night. Hopefully we'll weed out all the bad actors in the end, and crypto will be a nice industry.